Good morning. Welcome to Stock Market. Today it's Thursday, November 12th, 2020, and this is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the great content for this show. We also give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So, U.S. equities mixed in a quiet Wednesday session. Growth led value on the day as the latter took a breather after a powerful vaccine-induced two-day rally. Tech, discretionary, and staples outperformed while materials and industrials lagged the broader tape. Treasury market was closed for the Veterans Day holiday. Dollar was stronger on the major crosses. Gold was up 80 basis points. Crude oil was up 20 basis points, but well off the best levels of the day. So we get to the desk this morning, a little bit more of a mixed bag again. S&P futures down 20 basis points after Asian markets were mostly lower overnight, though Japan, remember we pointed out EWJ recently in the Nikkei, and China's Shenzhen finished higher. European markets are weaker. Treasuries are stronger with the curve bull flattening. The dollar is weaker versus the yen and the euro, but stronger against sterling. Gold up 30 bips. WTI crude is down 10 basis points to kick us off on a Thursday morning where the rotation battle rages on, but nothing else has really changed, right? So, the fight is under the surface, and that's always where it's the most fascinating to me, right? I know everybody likes to look at the averages. What'd the Dow do? What'd the S&P do? I think who cares is often what I say. Who's leading? Who's lagging? Where can I outperform, right? In my opinion, if, outperformance relative to some benchmark is, kind of what measures you as an investor. The benchmark doesn't necessarily have to be the S&P 500. It could be some other benchmark. But if you're not trying to beat it, I always kind of ask myself, why are you here? So under the surface is where we're trying to figure things out always. The battle is raging, right? We've had this back and forth between growth and value. Now, we're of the view that just kind of only owning growth is no longer the easy trade. We think that there are opportunities to be had in some of the more value and cyclical areas of the market now, and we're paying attention to them. But that's not a new view, right, for us. That's not, the vaccine is out, so let's react to that news. We got bullish on materials in June. We got bullish on industrials in August. This is just a continuation of that pattern, right? And it's not a switch. It's not a light switch. We don't turn off the growth light switch and turn on the value light switch. Right? There's a rotation that plays out. Still plenty of good growth stocks out there that are likely going to outperform the market. But the point is that there's probably some value names in there as well. There's probably some financials, maybe even some energy. We know that there are materials and industrials we've been chatting on. In the meantime, we have the SPY holding the breakout, 340 support, 320 below that. We have the Qs playing the game, 260 is key support. Above 280, we're playing for the September highs. And for IWM, we're near 160 support, right? 160 key support. So nothing else has changed. Find the relative strength. Try to outperform. Otherwise, just stick your money in SPY and spend your time doing something else. Let's look at our market in a minute. What are we writing about today? Well, mixed session as investors continue to square positioning. Breadth metrics favor the bulls as the equal weight S&P 500 is on the verge of outperforming, and that is fascinating to me. Global stocks break a 2-year downtrend. We'll take a look at the ACWI a little bit later on in the show. And as I said, futures point to a bit of a mixed open here today. And, it was a mixed day yesterday, right? Here's your mix. Remember, NASDAQ's been the big underperformer for the past few days. They were a big outperformer yesterday, and they get some juice to their power bar ratio, 20-11 bulls to bears. Dow Jones down 10 basis points, 2-1 bulls to bears. S&P up 0.75%. 143-48 bulls to bears there. Small caps flat, right, which makes them an underperformer, obviously, on the day. But their power bar actually looks like it's strengthened. 801 to 205. Bonds uptick, sending yields lower. Tech, the group that's been a source of funds for the past few days, and really the past few months, quite frankly, was your leader yesterday. And the group is still strong, right? So you can see 19-6 bulls to bears, right? So it's not, don't dump tech, don't dump growth. Right? It's a rotation. To me, it's a good sign, right? Because it speaks to this broadening breadth. Now, given where we are in the mix, I'm of the view that we are closer to the beginning of a cyclical bull market than the end. In my opinion, right? And I think that's starting to bear out with some of the stuff that's starting to outperform, with the fact that small caps have broken out, things of that nature. So I wanted to look for the areas of the market that could be source of funds. Source of funds if you own these stocks, or avoid them when you're looking for ideas. So I just kind of scanned the Russell 3000 for names that have bearish earnings growth, but are expensive, right? They have a bearish price to sales ratio and a bearish projected PE ratio. And in this case, bearish means they're expensive relative to the market and or their peers. But obviously don't want to stop there. The importance we place on relative strength. So I asked for the names that were weak from a relative perspective. And I didn't care about the rating here, right? I don't want a bullish stock that's underperforming the market, right? We might have a bullish power gauge rating on a stock, but if it's lagging the market, I don't want to own it. And especially if it has characteristics of weak earnings growth and is trading rich, right? I don't want to touch that. So the screen returned 59 names that, in my opinion, if you own them, maybe it's a source of funds and you go out and look for other opportunities where money is rotating, or at the very least, if you're doing some work and you come across these names, maybe you give it a second thought. Maybe you wonder whether or not you should actually own them. Regardless, we're always looking for a source of funds, right? There's an opportunity cost to owning something that doesn't perform for you. So screenshot this, take a picture, save it, come back and watch the show again. But I think this is an interesting group of names that, can be avoided, in my opinion. Let's look at our sector tracker now, moving to the major sectors over the last 5 days. All still bullish, all still to the upside, a little bit of moderation. We still have those big value groups at the top of the list, right? And we still have this, we have our cyclical trade at the top of the list still, right? Energy, financials, here's the ones we like, right? You can see it. And for those of you who are paying close attention to me on a daily basis, or at least a more consistent basis, you've hopefully seen my progression, right? We started to like this, then we started to like this. Over the past couple of weeks, you've heard me talk more about banks, right? Regionals, the majors. If you've read my notes on Tuesdays, you've seen me talk about the fact that financials in general look like they're bottoming. Like, it's probably not hard to guess the group that I'm warming to next, right? If you're paying attention, right? If you're paying attention to the nuance. And I got to tell you, I'd be lying if I said I wasn't at least learning a lot about energy right now. Middle of the road, utilities, REITs, and staples. Bottom of the list, tech, discretionary, comms, and healthcare. So it's a battle. It's raging on, and we don't know who's going to win. Maybe nobody wins. Maybe the market just goes higher with some tech stocks working, some energy stocks working, some financials working, right? And I think that'd be pretty good, right? It would show broad participation and broad leadership. It's, in my opinion, a big part of the bear case was how narrow the leadership was. Well, it's just the fan mags, or it's just these mega cap growth stocks. Anybody who was making that bearish argument has been proved wrong now. And if they're still making a bearish argument, they're just using something else. Probably not worth paying attention to people like that. It's intellectually dishonest. Anyway, let's look at our industry in focus: oil and gas, equipment, and services. Past 6 months, been an underperformer, although not as bad as you would think. Given how bad energy itself has been, the services group is only underperforming by 3.87%. Power bar ratio has actually turned bullish, 9-1. So like I said, we can't just kind of dismiss these groups anymore. It probably makes sense to pay attention. and do a little bit of work on a name like Next Tier Oilfield or ProPetro Pump or Select Energy. Very bullish, and bullish respectively. There's the fund trying to make the turn, right? Fund itself is still an underperformer, but trying to fight back. I don't think you can just dismiss this stuff out of hand anymore. It was easy to kind of just say energy is a disaster, let's avoid it. Like I've said it, you longtime listeners to this show know I've said it. I say it constantly. I mean, at some points actually pounding the table. I don't think you can do that anymore. At least not right now. I think you have to be a little bit more open-minded. Now, open-minded doesn't mean run out and dump all your money into energy stocks, but you should at least be paying attention. You should at least be open-minded. And I think that that's good. Let's look at what's trending. We'll run through this quick. No news on Etsy or News A. Qualcomm collaboration with Dish Network sends that one higher. Bio, the life sciences stocks were strong yesterday. And Corvo, no news. APD reported earnings, and then they called a downgrade today. Simon Property, some profit taking after a big rally. HSIC presented at the Credit Suisse Healthcare Conference. Ralph Lauren caught a downgrade, and PVH, nothing company specific on that front. I want to talk about the stock market. I want to talk about the charts. I want to talk about breadth, right? Because breadth, participation, leadership is broadening. Okay. I would actually argue we're actually at a point where it's a little bit overdone in the near term. And I actually referenced that in my note today. So for those of you who read my note, you'll see that it could be a little bit overdone in the near term. I mean, the percentage of stocks in the S&P 500 above their 200-day moving average, 84%. 84% long-term uptrends. The intermediate term, the percentage of stocks above their 50-day moving average, 83%. If we took this down further, which I do in my note, we would see that over 80% of the stocks in the S&P 500 above their 20-day moving average, 80% of stocks in the S&P 500 are on MACD buy signals. Okay, so pick your time frame, pick your style, trend, trade, what have you. Breadth is solid. We have more new highs for the advanced decline line, which tends to lead the market, right? Remember back in early October when we had the breakout here? And I said, this tends to lead the market, increases the odds the S&P is going to see new highs. What did we see on Monday, folks? New highs. We saw new highs. We opened at a new high. Our roadmap, everything we look at played out perfectly, actually. So we're going to continue to monitor the situation, but we're back at new highs. So let's expect the S&P 500, or odds favor the S&P 500 doing the same. To add a little bit more to the breadth development, the equal weight S&P 500, which has been a drag, right? It did not make new highs above the COVID highs until Monday. And now it's holding the breakout level. Right? So remember the argument, it's just the mega caps that are driving the market higher. You shouldn't be making that argument anymore. If you're in that camp, you've been proved wrong. And that's fine. We're all proved wrong all the time. But recognize you've been proved wrong and change your view. That's intelligent. The equal weight S&P 500 is gapped higher and is holding. Look at the performance relative to SPY. Maybe making the turn here. All while the RSI of this price shifts above the 50-day, above the 200-day. Right now, if your bear case was and has been narrow breadth, the market's proving you wrong. And then one last time, take a look at the ACWI breaking a 2-year downtrend line and on the verge of breaking a downtrend run on a relative basis. That'll wrap us for today, folks. Have an amazing Thursday. I'll be back with you tomorrow.